Good morning, everyone. This is Sean Stack, Director of Health Economics and Policy at the Ohio Hospital Association. Welcome to the second of OHA's 2018 webinar series featuring alerts, programs, updates, and topics of interest to OHA's finance and PFS members. We are excited about this opportunity to increase and improve OHA's outreach to its finance membership, and we welcome comments and suggestions for future sessions. Today's program, entitled Health System Executives, Primer on Tax Reform, will be presented in collaboration with Plante Moran to cover a few housekeeping points of interest before we launch into the webinar. This is a true webinar. There is no operator assistance. A webinar link and meeting materials were distributed previously, but if you have any problems with them or you need to contact Valerie Adams with any questions at val.adams@ohiohospitals.org. The session includes a PowerPoint-driven presentation from Plante Moran. Attendees can electronically ask questions throughout the lecture portions using the chat function, and the presenters will respond to them in the order in which they were received at the end of the presentation. This session is being recorded, and a copy along with the meeting materials will be available at OHA's Finance and Policy web pages under the links for finance news within a few days, and then in our monthly publication for February of By the Numbers. So without further ado, today's presenters from Plante Moran are David Lowenthal. David is a tax partner with Plante Moran's non-for-profit practice with over 20 years of experience working with a diverse group of non-for-profit, including hospitals and related healthcare concerns. David provides counsel on such issues as qualification and preservation of tax-exempt status, executive compensation, unrelated business income tax, structuring, and working for for-profit subsidiaries and international affiliates. He frequently represents tax-exempt organizations before the Internal Revenue Service in both examination and appeal levels. Amy Simonello is a senior tax manager at Plante Moran. She has more than 9 years of experience specializing in federal, state, and local tax compliance and consulting services, including a focus on taxation of exemption services. She also holds a role in Plante Moran's National Tax Office and frequently counsels the clients on Form 990 and specific industry topics that are hot. Amy has spoken for OHA before on the 501R regulations and also on exempt organization structures for-profit affiliates. So without further ado, I'll hand this over to Amy and David to begin our presentation.
Thank you, Sean. And we also want to thank everyone who's listening today. We know that a lot of you are very excited to talk about tax. However, our purpose is to not get deep into the details of tax reform. But instead, we want to give you a high-level understanding of the provisions in the Tax Cut and Jobs Act of 2017 so that you can be aware of potential impacts and know who in your organization needs to go deep into the details. There is a lot in this legislation, but we have narrowed it to the provisions we feel have generated questions and chatter among the healthcare organizations we work with. So for our agenda today, we're going to start with a high-level discussion of the impacts to a healthcare organization's bottom line. We'll talk about the new excise tax on executive compensation and other employee benefit changes. We'll also address potential impacts of charitable giving. We have a brief section on tax-exempt bond updates. We'll go through some examples for the new rules on unrelated business income. We'll also talk about some planning ideas to help lessen the negative impact. And lastly, we know that many of you have joint ventures with physicians and that you may get questions from them. So we've included a section to help you with those conversations. So first, let's quickly summarize the events from this past December. So what happened? What happened was the biggest tax reform legislation since 1986 was passed. It was a rush to the end of the year, and as a result, a lot of guidance is still needed to see the true impact of the tax reform. And so what we're wondering is what will happen next? David, what's your thoughts?
Thanks, Amy. So when they pass legislation like this, there's a lot of provisions that are put in related to sort of arcane issues like revenue scores, which meaning hypothetically how much revenue will be raised. And those are related to a variety of different legislative requirements. So without getting too deep into those details, the basic thing that we have is a whole lot of laws that were written. They were written rather quickly, and now we need to figure out exactly what they mean. And we have we don't have like a lot of committee testimony, but we have the IRS promising guidance. So if you can believe this, the IRS actually puts out something called their priority guidance plan. And they put that out each fall, and it's the list of their different areas that they're going to work on. And us tax nerd types are very excited by it. It sort of tells them the different areas where there might be a tax regulation coming. So just last week on the 7th, the IRS issued an update on that. And that update said, okay, we know that we've issued tax reform, and we know that we have this plan for the different provisions we're going to work on. Here specifically are things that we're going to work on related to tax reform, and a couple of them, including the unrelated business income provisions and the executive compensation, excess executive compensation, excise tax. Those two provisions were on the list of 18 new priority items. So what will happen is the IRS will clarify what the rules mean. Now, some of that clarification is going to come sooner, some of it, not as soon. When I've talked to some of my colleagues, some of my partners who are remember the last tax reform, and they said, the first year you're going to get some clarifications, but to really understand the playing field may take more than a year. It could take 2 to 3 years. Now, as advisors, we don't want to tell you to just sit around and wait for 2 to 3 years to see what happens. So we think there'll be some clarification coming shortly, and we think we have some insights into some things that you can actually do now. But Amy, what would they do now?
Well,
they had something to do.
I think that it's really what you should not do right now, and that's you should not be making quick decisions. We need to absorb what we know in the bill and then absorb the guidance and clarifications as they come. Where there does appear to be opportunities, we're going to mention that throughout the presentation, but really what you should do is spend time on your healthcare structure and make decisions that are tax efficient, but most importantly, beneficial to your charitable goals. So the first section we're covering is the impact to the Affordable Care Act, also known as the ACA. The Tax Cuts and Jobs Act did impact the individual insurance mandate that was generated by the Affordable Care Act, which was signed into law in March of 2010. The individual mandate related to the ACA's requirement for individual coverage, which could result in a tax penalty for individuals not complying. The Tax Cuts and Jobs Act repeals the individual mandate for insurance coverage. So this repeal is predicted to have a large impact on healthcare organizations because with the penalty gone, individuals may be less inclined to retain coverage. Stepping back, when the ACA was initially enacted, generally healthcare organizations saw an uptick in revenues. More individuals had insurance, and thus the hit to hospitals' charity care was lessened. This may depend on your patient population, but generally that was the result. With the repeal, it is reasonable to assume that this could impact bottom line if the patient population is heavily self-insured through the individual marketplace. And also, per the Congressional Budget Office, it is estimated that 13 million people will move from insured to uninsured status between 2018 and 2027. 4 million of those are predicted to move in 2019. So the question really is, how much of the 13 million will be in your own market? So with that said, the action item for organizations is to understand their patient population in order to grasp the impact that may be seen on a hospital's bottom line. Staying on this topic, another big consideration for your healthcare system may be reviewing your financial assistance policy. With the 501(r) requirements for hospitals that were a result of the ACA, many hospital systems have reviewed their financial assistance policies within the last few years. Now, with the increase in uninsured, more individuals may fall under your financial assistance policy. When organizations originally drafted their policies, it may have been based on an assumed higher percentage of insured individuals. Well, that's changing. So what can healthcare organizations do? You can involve your revenue cycle staff, VPs and directors, and make them aware of the potential impact and to assist with the evaluation of impact. You can understand your patient population data to assess the impact to the bottom line, and then evaluate the impacts of the patient population in regards to your financial assistance policy. Consider whether edits need to be made through the policy, but also think through the pros and cons of revising your policy. Moving to our second section, David's going to walk us through the provisions related to payroll and employee benefits.
So for us tax nerds, we're always excited when there is a new code section. Now, unfortunately, some of our excitement that there's now a code section 4960 is that that's the code section where there are excise taxes. In other words, and excise taxes usually are not a good thing. And I would have to say that this particular provision is very challenging for organizations that it applies to. So what are we talking about? We're talking about an excise tax on compensation in excess of $1 million applicable to the top 5 highest compensated employees. Now, if you're a health system with multiple employees, the top 5 is you look at the aggregate over the entire system. Now, the excise tax is with respect to the excess is only with respect to the amount above $1 million in compensation for any particular employee. The excise tax is paid by the employer, although it's on the employee's compensation. That's the measurement. For healthcare organizations, for healthcare systems, there is an important exception to the definition of one of your 5 highest compensated employees, and that is medical professionals do not apply. It does not apply to medical professionals. Now, that's great. And just like a lot of things with this legislation, there's some ambiguity as to when they say the top 5, and then they exclude a specific class, whether that means that the top 5 would include, for instance, you would take if one of your top 5 is a doctor, do you count that when you're counting your top 5, or do you exclude that person and move to the next person if you have an organization that has a significant amount of people above the $1 million threshold? Another thing that is not clarified is when you have a medical professional who has a dual role or who works in an administrative role, would they be considered one of the top 5? Now, our thinking / our understanding is, likely if you have, let's say, just take a fairly, what I think would be a clearer example. If you have a CEO of your system and he used to be a medical doctor and he still has credentials, chances are that that person will not be considered a medical professional. That's our assumption. But what about if you have a chief medical officer or a director or staff head of your doctors, and part of their role is administrative and part of their role is seeing patients? So that kind of thing hasn't really been clarified. One just important planning opportunity is if you're a fiscal year employer, if you have a fiscal year, the provision applies for tax years beginning after December 31st, 2017. And so what that means is that if, let's say you're a 9/30 year end, between now and 9/30/18, none of that compensation will be measured with respect to the 21% excise tax, or at least that's based on the plain drafting of the law. That's our thinking. And so it's likely that you would have an opportunity if you wanted to front load compensation into the current fiscal year, that could help you, at least in the short term, to avoid the excise tax. Another thing to think about is we're not 100% certain what exactly would be defined as compensation. Our best guess, or at least my compensation consultant's best guess, was that it probably would relate to Box 5 W-2 compensation. So Box 5 compensation is generally on a W-2 at your highest number. So if you have a 401k, that's Box 1, your taxable income will be reduced by that amount, but Box 5 will not be reduced by that amount. So it would, and that would mean, conceptually, that it would include your non-qualified deferred compensation plans, your SERPs on your key employees or your highest executives. It would include that income when it vests. So it would not include it every year when it's deferred, but when it's no longer subject to a substantial right of forfeiture and becomes vested, it would apply. So just kind of walking through this provision, the things you probably want to understand are, one, whether your organization qualifies. For some of the larger health systems, it's going to be pretty straightforward. For some of the smaller health systems, you may have 1 or 2 employees who has compensation that in a regular year would not qualify, but they may be building up some sort of deferred compensation plan that vests, over a 3 to 5 year period of time. And at that point in that year, it might be applicable. So down the road, or you may be in a position to restructure that. We'll have to see what the regulations look like. So the other thing is just to make sure that everyone, the board, that the planning people are aware of this, provision when you're doing your budgeting. You don't want to get to, the budgeting time, have this money set aside or not set aside, or not have people know what it is, and have people that are unhappy. So moving on to a couple or several sort of smaller ticket employee benefit items. So this one, the next one, moving expenses, I think is something to be aware of, because I know that in a lot of places it's difficult to attract key staff, key employees, and moving benefits historically have been something that you would be part of the package as an incentive to bring in new employees, new staff. And historically, if you move and you're moving more than 50 miles from where you live currently for a job, you would receive moving benefits. They'd pay for the truck, et cetera, and that would be non-taxable. Well, you can still do that. The problem is now it's a taxable benefit. So a lot of clients, just in my initial conversations, have suggested that, well, that sucks, but we're still going to keep doing that because we don't want people to be thinking about, the logistics of moving. We don't want another barrier for them to come and work for us, but it's just going to get a little more expensive. We're going to have to do what's called a gross up. We're going to have to pay for the tax impact of the additional income from us paying for the moving expense. The next provision, family and medical leave, there's a new credit available, which is kind of a little bit of a mystery to everyone. This actually was also in the 18 items that the service said that they're going to address by June 30th if they can. But there is a credit available for family and medical wages that are not mandated by state and local government. So I think we're going to have to wait and see exactly how this is calculated. And based on your human resource, your current policies, you may or may not want to take a look at qualifying for that. Fringe benefits, this has been kind of a tricky little provision that we've gotten a lot of questions about, and that is certain fringe benefits related to what's called qualified parking, transportation, and transit benefits are now subject to unrelated business income. So what does this look like? Typically, this looks like in a lot of urban areas, an organization will provide a incentive for a parking benefit or for a transit or gym benefit. And there'll be a reduction in wages from an employee's W-2. And then in turn, that employee will be able to take advantage of that benefit. So it's a way of making parking, commuting expenses, which are typically not tax deductible, of making them deductible. Now, the provision says that if you provide, say, like transit cards to your employees and you're paying for them, that they're still not taxable to the employees, but they're going to be unrelated business income to the organization. So it's a way of indirectly denying the deduction to you, to the nonprofit organization, because they wouldn't ordinarily get the deduction. So therefore, instead of denying the deduction, they're going to make it taxable. Now, the sort of straight and narrow interpretation of this provision suggests, if you provide these benefits, you would know that you're providing them as a basic benefit. The problem is that the definitions in the code, and this is a problem with, you'll hear this theme a lot, we're not really sure whether it includes just these like parking cards you would give someone would opt in to have parking taken out of their compensation on a pre-tax basis, or does it include when parking is provided free of charge by an employer as well? And so we're going to need some clarification, because obviously if parking is provided free of charge by an employer, that could bring in a lot of additional organizations. And if you went to sort of the nth degree on this interpretation, you could be in a situation where an organization owns a building and they're providing parking. Does that mean you need to impute parking income? Now, I'm sort of walking through this exercise not because I think that's the end result, but I want you to understand sort of the vagueness of these laws, and therefore the ability to kind of interpret them either in an extremely narrow, extremely broad, or hopefully a sensible way. So just wanted to kind of walk you through some of these different employee benefit and compensation issues. Now we're going to switch gears and talk a little bit about charitable giving.
So I just had two thoughts on this employee benefit slide. So with the family and medical leave wages, the credit's only available for 2018, 2019. So if you were to change your policy, the question is, do you continue with that even after these credits are? So that could be, employee relations thing to think about. And then for transportation and parking, that's probably going to more so hit the urban areas. Your Cleveland, Cincinnati, and Columbus type areas could be the ones that are facing that. Like David said, moving on to charitable giving, there is a lot of energy and discussion around the individual taxpayer changes. And one big question from tax-exempt organizations is whether any of the individual provisions will either increase or decrease the incentive to give. So if you depend on a lot of small donations, then you may see a hit, and that's due to the increased standard deduction for individuals. However, we assume very few of you are in that position. David, what's your thoughts on this?
Well, there have been a lot of sort of speculation as to, for the smaller donors, what's the impact of the likely loss of a charitable deduction. In other words, because of the way that the new tax law is written, it used to be that 15 to 20% of all taxpayers were itemizing, which means they would directly use charitable contribution deduction, and now it's going to be between 5 and 10%. So that's a pretty big reduction. There have been an analysis done by one government economic organization was that there would be a loss of $23 billion a year based on this provision in lost charitable donations. I'm not 100% certain that it's going to be to that quantum, but there's certainly going to be some level of loss. And then if you look at the other two provisions, the loss of the estate and gift tax exemption, and the increase in the estate and gift tax exemption, meaning that there's less of an ability there'll be fewer opportunities for the estate tax charitable deduction because there'll be fewer taxable estates. And then the increased charitable contribution limitation, which increases the limitation. In other words, the amount of the amount of the deduction in any 1 year was maximized at 50% of your income, and now it's going to be 60%. Both of these, although we're saying that the estate and gift tax exemption is a hurt, both of these could potentially be positives if you're working with wealthy donors and your development people, strategically are working through it. The increased charitable contribution limitation, I think, is fairly self-explanatory. People can simply give a bigger donation, and the other factor is that charitable donations only have a 5-year lifetime. So if you're a big donor, there are big donors that are always losing their in other words, they're giving so much away that they're losing their charitable deduction. So this means something to them. If people can't get a deduction or have less of an opportunity to get it from their estate, there could be opportunities, again, it's probably limited instances, but there could be opportunities to encourage lifetime giving as opposed to, putting it in their estate plan.
So really the takeaways are, look at your donor base, involve your foundation director, and then think through your fundraising strategy in relation to that base.
So tax-exempt bonds. So there was, in the original House version of the bill released in November, there was a provision which was going to do away with the tax-exempt status of what are called private activity bonds. And if you have bond offerings, your bond offerings are typically like 97% of the time private activity bonds. So that provision, if it had passed in the final act, would have had a really significant impact on municipal finance. That did not pass. What did pass was a provision that said if you're going to do an advanced refunding bond, which I'm not, just big caveat, I'm not a bond counsel, bond specialist. I know enough to be dangerous and fill out Schedule K on Form 990, but an advanced refunding bond is, roughly speaking, a method to refinance existing bonds. So these bonds are no longer tax-free. So what does that mean? I think what it means is a couple of things. One, it's going to be harder to refinance existing bond issues. At least it's going to be harder to reduce your interest rate to the extent you were able to previously, because the mechanisms for a municipal rate, a tax-free offering, will be harder to come by. It's not going to eliminate your ability to do financing. Probably the biggest impact will be in the supply of tax-exempt issues coming onto the market. So the speculation I had seen in some of the municipal bond publications was probably about a quarter of all issues are these refunding issues, and that will reduce the supply of municipal bonds. And so when you reduce supply, you increase demand. So it could have some interesting impact on the municipal bond market. The other things to remember, a couple of other things, is in something like a bond market, there are other factors. Interest rates are in general on the rise. Within the last week, there's been a provision for $6 billion of additional private activity bonds related to infrastructure. So these bonds, so there could be additional financing in the market. So there could be, the market could actually get bigger when we thought it was getting smaller for reasons that have nothing to do with the tax provisions. Nonetheless, I think when you're talking to bond counsel, it's going to be a little trickier, especially when you're looking to refinance an existing issue. Now we've come to the really fun and exciting stuff. The hard thing about a webinar is I can't do things to see if people are still awake, but I'm going to assume, I definitely haven't seen any like Q&A with like a big Z on it. So I'm feeling like we're doing okay. And we're going to move on to unrelated business, taxable income. And Amy's going to start us off.
All right. So Many of you have unrelated business activities and file a Form 990T. As a reminder, these are activities outside of your exempt purpose and therefore are considered taxable activities. We encourage you to share these slides and examples with your finance department as the roles can get a little tricky, or of course, call David or myself. We're happy to help. So going back to the slide, it's a snapshot of the types of unrelated business activities that are captured on Form 990T. And typically for healthcare systems, we see income reported from non-patient activities such as generated from laboratory services, retail pharmacy sales. We also see rental activities that may qualify as unrelated business income, and then also alternative investments. For activities prior to January 1st, 2018, you would report all of the unrelated business activities performed under the organization and net them together to determine if the 990T as a whole resulted in a net loss or taxable income. Under the new rules, for years beginning after January 1st, 2018, the unrelated business activities are subject to a loss basking provision. Essentially, that means that the different activities can no longer be netted together to determine an overall loss or taxable income. The impact is that for organizations with more than one unrelated trade or business, the net operating loss deduction must be determined separately for each trade or business and will not be allowed to offset income from other unrelated business activities. So this has led to the consideration of whether unrelated business activities should be structured in a taxable sub or taxable C corporation within the tax-exempt organization structure. And this is because your taxable C corps are not subject to loss basking provision. Also note that the tax rate is now 21% versus the progressive rate structure from 15% to 35%. And in addition, for those on the call with a year-end other than December 31st, this new rate will be a blended rate for your 2018 tax year. There is no blending year for the loss basking provision. The blending is just for the tax rate. Now on this next slide, David's going to walk us through an example of the potential impacts of the tax rate change.
Okay, so let's try to put some of these concepts down to numbers. So let's just start with the tax rate changes. So the thing to keep in mind that with the tax rate changes is that the 21% rate is flat. So when you look at that and you compare it to the old system where the rates were graduated for the first $100,000 of income, well, it was more than that, but the basic math was that up to $10 million, you were starting at 15% and going up until you eventually got to 34% flat amount at about $335,000. So when you walk through the math, that means if you were paying, if your income is under $90,000, you're going to be paying more tax under the current flat rate or the new flat 21% than under the graduated rates you were paying before. Now, once you get above 90,000, and I think the example we're showing 150,000, you can already start to see that the benefit from the new rate is pretty significant. The other, go on to example. So let's take a look now. So Amy, so we just went through the rates. Amy was talking about basketing. So remember, the general concept of basketing is each activity pays tax based only on the income from that activity. And if that activity has a loss, it cannot offset the income from another activity. So we're going to use what we believe to be a fairly simple example. So we've got a pharmacy, we've got net loss of 60 grand. We've got a lab, net income of 50 grand. We're going to make the stipulation. We think the stipulation will turn out to be correct, but this is just a stipulation. So don't take this to the bank. That pharmacy and lab are two separate activities as will be defined under the new law at some point. Also, we don't have any net operating losses carrying forward. Amy's going to talk about net operating losses, and I'm going to walk you through an example of that in a minute, but let's not worry about net operating losses for a second. Okay, so look at the second column that says 990T 2018. You can see that our $60,000 loss gets us, we don't pay any tax related to that, but it doesn't help us offset the $50,000 of income. And so therefore, when we get to the bottom line, our total income is $50,000, and we're going to pay tax on that entire $50,000, even though net we had $10,000 loss. Now the third column, we just sketched out, well, what if we have a C corporation? What if these two activities were in a C corporation? Then it's kind of logical, just the way the prior pre-basketing scenario was with a 990T, which is that you have a $10,000 loss, and you're going to carry that $10,000 loss forward. But net, we end up paying no tax. So the thing to think about in this scenario, this is kind of the first possible planning idea, is there are going to be instances where organizations have a significant amount of activities, and they're going to have unpredictable from year to year income and loss streams. And when you know that you're going to have income in some years, whenever you have income, you're going to pay tax. I mean, just the basic rule of this law is if you have an activity and you have income in a year, you're going to pay tax. And that means that there might be an advantage to having your multiple activities in a for-profit subsidiary where you can just net them all in sort of the straightforward, logical way that things had been before. Now, before I go any further, we're tax accountants, and we, love talking about taxes and love drawing boxes and moving entities around and doing all sorts of wild and crazy things. We understand that moving activities from entity to entity can have all sorts of state law, management, and other ramifications. But from a tax standpoint, this is kind of something to keep in mind. Now, Amy is going to introduce the NOL concept. I'm sorry, NOL is net operating loss or loss.
So this is really where it starts to get pretty tricky. So for net operating losses generated after 12/31/17, they can only offset taxable income up to 80% of taxable income. So no longer can you wipe out tax liability with a net operating loss unless the losses were generated prior to December 31st, 2017. Now, some of you that are listening may have large taxable subs or C corporations or even 990Ts that have been generating losses for a number of years and is projected to continue to operate at a loss. So these rules really don't impact you. However, outside of reform, but still worth thinking through, is that the IRS could potentially challenge your losses, especially if there's an allocation of expenses or management fee between the health system and the taxable corporation. And we've seen these situations challenged before. It doesn't mean that a loss-generating C Corp is not allowed, but it can definitely grab the IRS attention. Now, for those of you not in that position, we do have an example on the next slide about how these net operating loss limitations work.
Okay, so now we've got a similar facts as before. We've got 2018, we have our pharmacy with the $60,000 loss, the lab with $50,000 in income, and the basketing provisions will treat that income as taxable on the lab. Now, we're going to go forward to 2019. So the good news is that pharmacy activity, that $60,000 loss, while you can't use it in 2018 against the lab, you can use it if the pharmacy ever has income in the future. Now that's the good news. So we go to 2019, we have $40,000 of pharmacy income. So we take our $60,000 loss and we apply it as much as we can against the pharmacy income. So the question is, how much can we apply against it? So the new net operating loss limitation means that we're only able to use 80% of the net operating loss. And so the net effect of that is that we end up using, I'm sorry, I didn't say it perfectly, and hopefully you follow, like looking at the math. We can only use 80% of it against the existing income, meaning not 80% of the loss, but we have to look at the income, take 80% of that income, and if we have enough loss, we can use that. So that's how we get the $32,000 of NOL usage, leaving us with $8,000 of taxable income and an NOL carryover just for the pharmacy of $28,000. So the thing I think that about the combination of the basketing provisions and the NOL rules is no matter how big a loss you have in any one year, whenever you have an activity and it has income in a particular year, you will pay at least some tax. And that's the thing I think that is going to be kind of painful or extremely painful in a lot of instances with respect to these rules. Now let's look at if we have a situation where we have losses prior to 2018, so a pre-2018 NOL. So now we'll just go back to 2017. We've got our same lab and pharmacy. Net, we lost $40,000. Remember, this is the old rules. We could take our income and our loss. We could net them. We have a loss at the end of the year, and that loss is going to carry forward to the next year. So now we go to 2018. So we're going to same basketing rules as before. We're going to end up with the $50,000 because the $50,000 from the lab cannot be offset by anything. But now we can use our pre-2018 NOL, and the good news is we can use all of it. Not 80% of it, not 80% of it against the income, just we can use all of it. And so in this scenario, when you're walking through the math, the pre-2018 NOL has the most economic value. So, because you can dollar for dollar take it against the bottom line income going forward. So, Amy, do you want to talk a little bit about, might there be any guidance or things coming to clarify this going forward?
Yeah, and as we mentioned earlier, and David, you just said it, there needs a lot of clarification. And one of those being how to group your unrelated business activities. And our examples clearly show two different activities, or so we can assume. I mean, who knows, they may group non-patient activities together. But what if you have rental income that was a result of multiple building sites, or maybe you have multiple different tenants, or you have two pharmacies with non-patient income? You may even have multiple alternative investments that generate unrelated business income. There is no guidance on how you can group activities of similar nature or if everything is separate, and this makes projections and budgeting very tricky based on the provision as written. And as David mentioned earlier, the IRS did release a priority guidance listing, and their plan is to provide more guidance on the unrelated business activity loss basking provision by June 30th of this year. So stay tuned for that. So
something to think about, and just, and this is kind of thematic, we've said this a few times. So there is some ambiguity with these rules. We're waiting for guidance. I've had some conversations with people either who are in the government, but principally people that used to be in the government but are not there anymore, trying to kind of, what's the worst case scenario? Because for instance, in what Amy was just talking about, there are foundations and employee benefit trusts that maybe have 200 different investments that generate unrelated business income. And does this mean that investing is one passive activity and that's it? I don't need to worry about these rules. I can just do my return as I've done it in the past, or I have 200 different activities that need to be basketed. So I actually had a conversation with someone that was involved in drafting not this exact basketing provision, but the provision that it was based on in a prior tax reform draft from Congressman Camp a couple of years ago. And he said, look, when we were drafting this provision, we were thinking about sort of the scenario that we had laid out in our example, the lab and the pharmacy. We were not thinking about Harvard's investment portfolio or some sort of organization with a whole bunch of investments. So that wasn't our intent. And then he said, well, but I don't work for Ways and Means anymore. And, my word about what we were intending does not really have a lot of weight with the IRS currently. So, the point being, it's easy to come up with a doomsday scenario. I've been doing this enough time to sort of, my sense is that if the IRS were to come out and say, every endowment or investment portfolio needs to keep track of every single basket, every single one of its K1s, that there would be a fairly large outpouring of outrage. And the outrage would not be offset by anyone saying you're being unreasonable. It would just be outrage. And probably there would be, the government would have a lot of trouble letting that provision stick. Now, I'm not, my opinion and sense of history and perspective, I wouldn't say take it to the bank, but my sense is that we'll get some clarification, and that in that process, it will be something akin to the, pharmacy lab possibly, and, possibly taking a look at some of the areas that are harder to, distinguish. Is it all my labs? Is it certain types of labs? What distinguishes an activity? I think that's going to be the tricky piece. But I do think that the IRS will do their best to try to clarify it, and they did not write the vague law. So Amy's going to take us through a few of the other provisions related to income tax.
So we do have a couple of slides on some random items that may apply based on your specific situation. So if you have a taxable sub or C corporation that has purchased or plans to purchase depreciable assets, then there is a new provision that has increased 179 expensing limitations, which is essentially writing off the cost of the asset. And there's also 100% bonus depreciation enacted for assets placed in service after September 27, 2017, which again is essentially writing off the cost of the asset in the first year. We don't see this too much, but in cases where it does exist, the benefit is helpful to reduce taxable income. This slide is more of a FYI item for our larger systems that may have been paying tax due to AMT in the past. And personally, in my experience, alternative minimum tax typically came into play when utilizing net operating losses. The net operating losses were limited to 90% of taxable income. Well, AMT no longer exists. You are not subject to the 90% limitation on net operating losses generated prior to 2018. Now, post-2018, net operating losses are subject to the 80% limitation we discussed earlier. However, for losses generated prior to 2018, those losses can offset 100% taxable income. And the point is, and I believe David mentioned this earlier, is that if you have pre-2018 NOLs, they're actually worth more today.
Revenue recognition. So there are new provisions under GAAP with respect to revenue recognition. The main objective of this slide is kind of to remind people, if you haven't been reminded already, that there are these new provisions. Please be aware of that, and that there's a possibility they could accelerate your revenue recognition, and that could have an impact not just on your GAAP financials, but on your corresponding revenue recognition for tax purposes if it relates to an unrelated activity or if it relates to your for-profit subsidiary. So let's just try to summarize all of these different unrelated business activity and taxable C corporation provisions. I would say these specific provisions, the loss basketing, are the ones that if you have a significant amount of activities or what could be a significant amount of activities, you really need to get in touch with your advisors and have a discussion and sort of assess, what might happen, what could happen, what's the best case scenario, what's the worst case scenario. Understand if we've been identifying these three different things on our 990T as different activity. If we carry that forward and sort of use loss basketing, what's that going to look like? And there's some other things going on. The NOL situation. Am I going to be generating NOLs going forward, and what sort of interesting asymmetric problems will that cause? And do I have old NOLs, and how can I use them? And finally, when I look at this whole mess, and it looks like just about any way I slice it, I'm going to be paying a lot more tax. do I want to look at setting up a C corporation to house all of my different unrelated activities? Then, of course, there are going to be some non-tax reasons, 990 disclosure issues possibly, and different kinds of state law provisions that may come into play. But the last thing is, so you want to talk, I think, to your external advisors, or if you have in-house tax, definitely going to be having a conversation with them. In addition, you're going to want to make sure your financial staff is in on it in case there's an economic impact, a budget impact, so that someone's not surprised that their budget line is like a little bit lower than they had thought in the past. So real quick, we're going to talk about joint ventures with physicians, and then we're going to wrap things up.
So we snuck in a couple slides unrelated to tax reform, but we still serve as a very good reminder. Effective for tax years beginning after December 31st, 2017, there are new partnership audit rules, and this is where you want to ensure you're working with your legal and/or tax advisors. These new rules allow the IRS to collect tax at the partnership level on adjusted partnership items at the highest corporate or individual tax rate in effect for the audit year. So often this can lead to the wrong amount of tax due since tax exemption is ignored under these rules. So you are paying tax when otherwise you would not be. Also, you could be paying the tax on behalf of a former partner, as the new audit rules put you on the hook for prior years. So how can you avoid this? You can elect the push-out method. This push-out method takes the audit to the partner level who were present during the year of examination. This mitigates potential distortions under the new rules by requiring the review year partners to bear the tax liability. You could also opt out. So what this means is that you go back to the old rules. This essentially allows the IRS to proceed with the audit against each partner separately. These opt-out option only applies to small partnerships who have 100 or fewer partners that are individuals, partners classified as C corporations, an S corp, or an estate of a deceased partner. If your tax-exempt organization is classified as a trust, this could be an issue. You can further protect yourself by reviewing your partnership agreement and amending where necessary. What is challenging when applying these rules is that the avoidance techniques and essentially the control as to how to handle an audit and special issues are silent in the partnership or operating agreement. And many of these agreements haven't even been reviewed since inception. So to protect your organization, you need to work with your legal and tax advisors to review your current and future agreements to ensure that these new audit rules are addressed. And at a minimum, ensure that a partnership representative is defined in the agreement, since that representative can bind all partners with respect to the partnership matters. And this slide includes some examples of the provision. It's not an all-inclusive list, but I think it's a good starting point. In this next slide, we're going to talk a little bit more about the actual tax reform impacts to the partnership and what physicians might be asking you.
Thanks, Amy. So tax reform has a lot of provisions that affect regular business and individuals. And the thing to keep in mind with respect to your joint ventures or your partnerships, anything that would be that would have the impact of taxing the individual owners in some way by the results of the business, is that there's now a provision called qualified business income deduction that provides a 20% of qualified business income, a deduction of the business income on the individual's tax return. And so the net effect of this is that hypothetically, if their business qualifies, they, let's say, have $10,000 of income, they're going to get a $2,000 deduction. So we think that in some instances, this could apply to joint ventures. With respect to service income, there's some pretty significant limitations on the applicability of this rule, but we think it could apply in some instances. And the reason we're bringing it up is we want you, when you're working through these kinds of agreements, just to be aware and to make sure that you're checking with your advisors to make sure you know if there are different incentives that previously existed with respect to your partners in these ventures. So now we're just going to wrap things up, give you just a little bit to think about takeaways from our presentation. Amy?
So for the ACA changes and the individual mandate repeal, you need to consider this in financial planning, understand your potential change in payer mix, and then modify your financial assistance policy if it's deemed necessary, but of course considering pros and cons as well as that in your policy.
So for the new excess compensation rule, if you have a fiscal year, we feel pretty confident that you're going to have an opportunity at least this year to do something to mitigate, at least for 1 year, the impact of the tax. We also think that once the IRS comes out with clarification that there may be some opportunities with respect to your plans, both your executive compensation contracts as well as your deferred compensation plans related to those. On the employee benefit side, we're going to need some clarification with respect to some of these fringe benefit provisions, and just be aware that your recruitment costs with respect to the moving expense is going to be a little bit more than it's been in the past.
So for unrelated business income, really involve your finance department and your tax advisors, because you need to evaluate the impact of these basking provisions, understand what your net operating losses look like, and then also thinking through, should it be in a for-profit sub? And of course, there's the pros and cons outside of tax consequences you have to consider. For the partnership side of things, just understanding that your partners may have different incentives under the new law, and really stepping back and looking holistically before jumping to any kind of entity change, and having a good conversation about what makes sense. And then lastly, do not forget about the new partnership audit rules. These can get pretty nasty if you don't protect yourself and work on your partnership agreement amendments. And I believe that's really our summary of our takeaways. So any questions?
Let's see. Amy and David, can compensation be structured in other ways that could defer or reduce the amount?
So, the short answer to this question is maybe. If you have a fiscal year, we feel pretty confident that you can do things to accelerate either the recognition of income in a deferred compensation plan, or if you have bonus provisions that typically, vest or accrue at the end of the year, we feel like you probably could set it up so that it's, let's say, paid out at the end of the year, and then if it's based on metrics, you can true it up into the next fiscal year. In terms of sort of the specific ways, could you, let's say, put your deferred compensation plan in a for-profit subsidiary, and then that would allow you, or at least it does under the current law, to spread out the vesting? Can we do that? And when that run afoul of the new law? We're not certain. I mean, we really, before I would tell someone to do something like that, I would want some guidance a lot of guidance from the service.
Okay, thank you. In reference to the physician exclusion impact to the top 5, if a physician is included in the top 5, is he bumped from the top 5 if his compensation is for professional medical services and then replaced by the next top person?
Well, we don't know. I think a reasonable assumption is that that's probably the case, but the way the law is written, it's not 100% clear.
What are organizations doing until more guidance is available with regards to the UBIT basketing, particularly for alternative investments? Are we going to continue treating these as one activity for now?
So I think the best thing to do with UBI is stepping back and really looking at what different, I don't want to say buckets, but essentially what different buckets do you have? With alternative investments, like David said, I don't know if the intention is necessarily to tax every single K1, but it's probably a good idea to just step back and look at what you have individually and understand, are they loss generating, income generating, and just get a solid understanding of, in my case, I like to be conservative, worst case scenario.
With the reduction of insured individuals, what are your thoughts on bad debt?
So that would definitely be something that would, I think we can predict could increase. So something, again, to consider in financial planning, that bad debts could have an impact.
Do you recommend that the hospital is listed as the partnership representative for new audit rules?
So on this one, I would say absolutely, because that puts you in the control position in order to make decisions, especially upon audit. So in my mind, that's where I would want to be, especially if I'm the tax exempt and I've got an exemption to protect and tax to avoid if it was to be applied at a partnership level.
I think just kind of to boil down the new partnership provisions, what you want to remember is if you do nothing, the new law basically says they will come in, they will audit the partnership, and they will assess tax on the partnership. Absent, there's no if you don't do anything, there's no provision to allow sort of the normal reasonable thing to happen, which is the people who would owe tax, and the people who are not taxable wouldn't owe tax. So you want to make sure that's why you got to do something.
Well, and I think too, and I've heard this in conversation a few times, throughout looking at these partnership audit rules, is potential for private benefit. Because if you're paying tax for a prior partner that happens to be, a physician or whoever it is, you're paying tax on behalf of someone else. So could that be private benefit? Well, I think there is risk there. So, there's just a lot that you need to review in your agreements to make sure you're not tripping up.
What's the timeline for more IRS guidance? Did you just say June or?
So the IRS has indicated that the 18 points that they highlighted on their update to the priority guidance, that they expect to have something out by June 30th. They also, a separate statement said that some of the other provisions, they're still working on other provisions just because it wasn't mentioned among the 18. So, the hope is by June. My guess is that I think we'd be lucky if it's by September, but I'd be happy for the IRS to surprise us.
Yeah, I think that, and I think that might have been our last question. There's a lot of uncertainty. There's a lot going on in this tax reform. Of course, if you have questions, reach out to David and I. We're happy to answer them individually. We have our contact information in the slides. If you would like to reach out for further conversation, or as you're getting into any of these things, executive comp, unrelated business income, we're happy to help and bounce off ideas. So be sure to reach out if that's the case.
Great. Well, I want to extend appreciation to David and Amy today and Plant Moran for offering this informative session on tax reform. The session is being recorded, and an archived copy along with available Plant Moran slides will be published to Finance News before the end of the week, as well as to By the Numbers for our monthly newsletter. So if you do need to reach out to David or Amy on any additional questions as you're going through these rules and guidance, their slides will be in there with their presentation numbers, so please do so. At this time, I want to point out the new upcoming March 13th Health Economics and Policy webinar will be an update from KeyPro, Ohio Medicaid's Program Integrity Auditor. And with that, I believe we're done for the day, and I want to thank you for joining us today for our OHA Health Economics and Policy webinar. Thank you very much.